I can see the big stick candle here. Retrace back, retrace back. I told you all to short when you break the immediate low of 1.8285 on 3rd of October. Since then, I still stay valid in my assessment that we are still in the bearish cycle trend. Okay, for short pound, if you do it spot forex, you are short pound USD. For those who are interested to short pound, my advice to you, unless you do day trading, ultra trading, my advice to you, enter enter for swing position trade when market drop below 1.200 level. Any questions? Okay, so pound, I swing pound. I made a lot of money, frankly speaking. My position sizing is not that big. But then I holding out for a long time already. I said earlier, this is a nice swing position trade. Any questions about anything? Thomas, I don't have the budget. Thomas, I want to trade pound, but I don't have the money. I don't have the margin. I don't have the money. Okay? If you tell me this question, it's quite simple. You can always you can always use options on, okay, pound ETF or pound futures. FXB is the pound ETF, but I'm not so sure the option is good or bad now. Okay, let's say now you want to short a pound. So you right click here. You look at January 2017, 87 days away. You want to short a pound can. You can short a nice this type of trade is not day trading or intra-week trading. You are looking at the big move. The options available is not very good. You can see that. This is 1.21220, 1.1500. Okay, now here is count as cents. Okay, Thomas, why is no peak spread here? It's not peak spread here, and why the price is different? The price is different because when you trade forex, there are multiple different underlying. So if you trade futures, futures will give one set of pricing to you. If you trade forex, spot forex, the price for pound USD will be different. If you trade FXB now, this is what you can see here, currency pound sterling trust, the price will be different. Why is it all different? Because each underlying, like futures like that, futures is forward looking British pound currencies. Okay, FXB, also called the British pound ETF. Okay, is what we call literally spot ETF. Means that real currency, hard cash ETF. Then the spot currency, the pound USD, whatever is what we call synthetic. Means what? Because when you trade a spot broker, you are trading with a market maker. Whether the market maker is done at the brokerage house level or the market maker is done at the wholesaler or at the bank level, whatever, is still considered done as a private third party arrangement. Any questions so far? So Thomas, I believe pound will die horribly. Fine. You go over to this one, June 2017. 237 days away. You can buy a 118 put for around $4.20. This is by nature a very long trade. You are hoping pound to go down to 1-to-1 level. So with options trading, you are able to trade flexibly to trade in many different ways. This is one. Okay, why don't we look at pound futures? Sometimes pound futures got options, sometimes don't have. We see what we have now. See pound futures. Good news, we have pound futures here. Option pound futures. Right click it, January 2017. Exactly the same thing again. Exactly the same thing again. Okay, just now we will look at the price. Just now was 118, correct? Here is 11215. Because why? Futures pricing is different from spot pricing, which is different from cash pricing. Anyway, let's do a round number up. Okay, let's do a 118 here. And you can see from here, it's blank off here. That means what? This broker, Think or Swim here, have decided not to let retail account, this is by the way, this is a retail account, to trade pound options on pound futures. So now, if you really want to do it, yes, my advice to you, go to FXB and go and buy June 2017. That will give you enough time at $404 over each. That will give you, I will say, enough bang for the money. Any questions so far? Okay, now it's 10:07. Okay, in another 1 more minute or 2 more minutes, we will start the class. Officially, we got about 20 people registered. So far, only 11 turned up. Not a problem. Okay? Any questions about options? Options, through options, we can trade almost every classification of instruments. Okay? Any questions? If not, let's start the class proper. Good question. Where to earn this one? I think I did explain over. You can, Mr. Ko, you can go back to look at the notes. But anyway, I have prepared this one for you. Yeah. It's right over here. Okay, as you can see from here now. This is Nasdaq earning calendars. One of the better one. Okay. This one can literally show you all the underlying you need to see. Mr. Hawk, can you see it now? This is one of my favorite ones. Another one which I recently I sent to you just now to WhatsApp group is our good friend the CBOE, the one. That one also not too bad. This one is the actual full scale detail one. Today is what day? Now it show 25th October. You can see 25th October here, right? So now for today's we are looking at two underlying. One, Appl. Two, Mr. Google. The reason why we're looking at these two, because these two are the most well known, have enough liquidity. So like Appl like that, of course you can always buy Appl shares or short Appl shares or whatever. But if you look at Appl now is $117.73. Do you think it's a good idea to short or long Apple shares? Because anytime go earnings, you can see from here earnings here, see here. One is the earnings here. From here, how many? This is a $5 move leh. Here another earnings here, another $5 move, another $5 move there. So earnings here move $2 plus. So as you notice by now, the last four earnings, Apple can move as much as $6 to as little as about $2.53. So buying mother shares is not a good idea. Thomas, mother share is safer. I can long or short. Why don't I show you example? Recently we do a next week trade. We lost money on this one. Okay, next week trade. For example, earnings from $100 shoot up to $117. Now, yesterday almost hit $130 and now is 126. So the problem is this: is that trading mother shares as earnings trades is extremely dangerous. Just imagine you put in, you say I short 100. I believe next week is bearish. The thing shoot up to here now. You easily lost $17 per share. Nothing losing $17 per share if your account size is $500,000. But it's $17 per share for a 20K account. That is very bad and very wrong. So now you understand why I want you to use options instead of shares to do earnings trade. Okay, those people who do it into cover calls, buy shares and sell calls, please do not do through earnings. Mr. Goog at UE, can you hear me? Mr. Goog, UE, can you hear me now? Okay, let me on off again. Testing 1, 2, 3, 4. Can you all hear me? Can you all hear me now? Testing 1. Testing 1, 2, 3, 4. Can you all hear me? Okay. Now, okay, let's go again. So, do be careful. Okay, remember, what is the objective of trading? Trading is to generate alpha. Means what? Short-term profit as fast as possible. When you invest in shares, who wait for 2, 3, 4, 5, 10 years, that is for capital gains. Capital gains and share and trading is two different separate objectives. Trading objective is to maximize turnover, trade turnover returns as soon as possible. For those who come late, let me show you again. This is where we get our earnings calendar from. Okay, this is where I'll get our earnings calendar from. As you see, come here, go down bottom part, Apple. Can you see Apple here now? Apple is here, stated October 25th, September. All the expectations. You can see at the time here now, time divided into two time. Daytime and nighttime. Simple. If you see the sun, that means what? The earnings announcement will come out before the market open. Okay, so if you can see the moon, you can see the moon now, the black and the white and the black here. This one is telling you the conference call or the earnings calendar will be announced after the market close. So you can see now, this is October 25th. Apple is over here. It's got one white and one black. The moon pattern is telling me that the earnings announcement will come out after the US market close. For Google now. For those who want to find, you can find by date or you can find by name. You can find by company alphabet. See now, I type Google, I press enter. Google is on 27. You see, 27 October. Okay, after me here, 27 October, after market close. Means what? The white and the black moon again. So this trade is 27. Where is 27 October? 27 October is this Thursday after market close. Any questions? Any questions? Now, there is many ways of trading earnings. Okay, let me share to you let me show you a few ways. Let's look at Apple for example. Okay, Apple earnings, after earnings will happen possible three scenarios will happen to Apple. Apple make new high, shoot up all the way up some more. Apple bad news, drop all the way down. Apple news as market expectation go sideways. Okay. So now we are at this moment in time, at this stage in time, I will not be showing strategies that trade what we call multi-dimensional trading. That means that up make money, down make money, sideways make money. This is not, you're not ready for it, so I will not teach you. For Apple trade, I intend to do what we call a range bond trade. Okay, let me explain what I mean by a range bond trade to you. Look at Apple here. Apple, like all instruments, options is unusual in the characteristics. It's very unusual in the characteristics is that Apple options is forward looking. When you buy a share or sell a share, you are selling a what you call cash settled. Means that you're buying a cash, you're buying a share. You buy Apple share. Apple is what we call cash settled. By nature is infinite history. Not like options. Options got 28 October, 3 days to expiry. 4th of November, 10 days to expiry. And whatever knots inside we have. 11 days to expiry we have also. So options like futures are derivative based. All derivative based have expiry. Okay, it's like CFDs do not have expiry, but you pay commission, you pay carry cost, same like derivative. But compared to CFD, compared to mother shares you pay one time only it's forever yours You don't need to pay what we call interest rate fee carry on fee pay for time premium and so forth. Question so far? So now I make it short and sharp. Then I make it faster a bit. So anybody want to trade app for this coming earnings trade Apple and Google? Anybody give me a risk budget? Anybody interested to do or not? If you're interested to do, give me a risk budget. Give me a risk budget so I can structure a trade based on your risk budget. Anybody can hear me or nobody can hear me? Okay, fine. What is your risk budget for this trade? Apple and Google. Okay, Apple $100. Okay, Hawk. Chatai said $500 USD each. Okay, good. Nothing wrong with it. Okay, you all notice by now, ladies and gentlemen, that I'm teaching you to trade based on nominal trading capital. I can show you strategies that you need to have $10,000, $20,000 to do. But in this case, whatever I'm teaching you tonight is fixed. As much as possible, it's going to be fixed risk. Okay? Of course, I got one adventurous guy sent message to me privately asking me, Thomas, I'm prepared to hold share risk. Fine, I will share to you how to do a trade with shares risk. Okay, couple of things first. For those who just don't understand, risk budget is defined as the amount of money you're prepared to lose all in one trade. So if a chart type put a risk budget of $500 means that he prepared maximum trade wherever how bad it is happen, he prepared to lose $500 only. Okay, then somebody sent me private messages. Thomas, I prepared to hold share trades. Means that share risk. Share risk is the price of underlying. Look carefully, what's the share price now? It's $117. So share risk for this trade is 1,200 US dollars. Not everybody have the budget. If you have, there's much more flexible and much more creative way of trading. So why don't I do the following things for you now? structure a trade that the budget of $100. We start with the cheapest trade first. Now, when you trade, now objective for this trade now is to sell premium trade. Means that because option premium is very high, because tonight Apple got earnings announcement. Okay, make sure you mean so you understand better. If you notice happen tomorrow, this Friday night, okay, 28, 3 days away, is $2.40. Okay, here, okay, 17 days away is $2.67. Means what? No much difference. That means what? This option premium is now very expensive for 28 October expiry because of the earnings announcement tonight after market close. So now we are going to do what we call a earnings income trade. A earnings income trade is different from a S&P 500 normal income trades. I will explain to you more detail later. So most of the time, you all been taught to sell D15 price action value and whatnot. Okay, let me share to you four different strategies for this to do an income trade on Apple. One, sell a sell a naked strangler. A naked strangler will get you $4.53. This is considered the most aggressive form of trading. Why? First, is you're selling at the money. Secondly, okay, you are selling through earnings. This trade, your risk budget for this trade is what we call share risk budget. Okay, on paper we make $455 here. Okay, $455 here. Maximum loss is infinity. Okay, margin by effect now add up together is almost $2,800 by effect. But your real risk for this trade now is about $12,000. Because if the thing shoot up a lot, like next fix like that, then you will be assigned short shares. If the thing drop below 117, you will be assigned long shares. So this is what we call share risk. Any questions about this one? This one is considered the most aggressive form of what we call premium selling through earnings. Any questions, gentlemen? Okay, this one we will not do tonight because this one is supposed to be at lower level class for you to test out whether you like the excitement now. So Thomas, you're telling me we can sell D numbers. Thomas, I sell D15 can not? The answer is, frankly speaking, my advice to you, no. Okay? The money you collected is not justify the risk. Yes, you can sell 1-2 minus, short 1-4 call, hedge by 1-6. The money you collected is not justifiable. Let me show to you what I mean by not justifiable. Short 1-1-12. You collect 22 cents for $1. To me, it's not worth the risk. I repeat, it's not worth the risk. Another way of doing it is to use 1 day price action value, sell out of the money. So let's say as discussion purpose, price action value now is $3. So now what $3 now? $3, 117 plus $3 will be 120, 121 here. Okay, let's show let's say based on price action value out, sell 121, hedge by 122. Then the downside is 117 sell to 1114. See now, how much? 117 minus $3 is 1114 or 1112 depending on you. Okay, let's say 11 sell to 11 sorry, sell 1112 H19. You see that? Now you collected 44 cents, 45 cents. Then this trade more worth it now? Yes, it's more worth it. Right click. You can see now. When you do a earnings income trade, your return is expected minimum at least more than 50% return over risk. Not like a normal income trade with S&P 500, we are expected to collect 20-25%. A real earnings now we have now doing is we are collecting 45, maximum loss is 55. Good now. So lah, it's about 80% return over risk. Any questions so far? So this is one way of looking at it. Of course, there's another way of looking at it is to use option premium analysis. Okay, to make it simple, so you just take the now option premium now and the money call is around $2.40. 117 plus $2.40 now become what? It's become what you call 121 here. Is it 290? Yes, around 121 here. So match here. The option premium analysis. Okay, 11777 minus $2.10 here will give you 215, 214 over here. So you can do in two different ways. One, use the price action value. Okay, or two, use option premium analysis and the money option premium analysis to do the trade. So let me bring up both trades, then you all decide which to do. Here, option premium analysis indicate the price action analysis match. Here, 117.80 minus $2.20. So now it's $15.60. So we go down to $15 level. So we are going to put 15 put here. And we'll finish for. So both of these, you see now, this one a better trade. If you use based on option premium analysis, your return over risk for this earnings income trade, earnings premium trade, sorry, not good, earnings premium trade is better than 100% return. See lah. Maximum loss is 38, maximum win is 62. So, ladies and gentlemen, can you give, in your personal opinion, which one better? Collect 45 cents better or collect 63 cents better? Second one better. Mr. Hawk said second better. So you said Mr. Hawk 61 cents better, correct? Fine, nothing wrong with it. In fact, both of them are what we call reasonable good trade. 45 cents one, of course, have higher probability of success. 62 cents one have higher returns. How about the rest of you? Alexi, Chattai, Yui. Okay. First one, second one. Anyway, both are equally good. Both are equally okay. After it's quite decent return now. This one, the first one, easily will give you 90%, 80% return. The second one will give the much more, even higher returns than that. Okay. Now this one easily will give what 170% return. So whichever one you choose, not a big deal. By the way, these trades are stand-alone trades. Means what? Once we sell, we leave it alone, and if we need to, we take profit. If we need to, we close the trade to take loss. Maximum loss on the trade is like income trade, right? 100% hedge. Sell one, buy one, sell call, sell put, buy put, sell call, buy call. So it's 100% trade hedge. Any questions? Anybody interested to do a naked strangle? No. This one got 3 there. And the first one we have the first one the 45 cents one we use D numbers are OTM. Okay. Now the second one you use based on option premium, means that option dollar value. Okay. Okay, fine. I will do one based on a naked strangle. Okay, based on option premium analysis. Option market for this trade call is $2 and okay, make it 250 lah. Make it a nice number. Market value now is 117.80. 117.80 plus $2.50 give you 2121. So you right click here, sell a strangle at 121. Thomas, wow, I'm very happy now, Thomas. I collected $32 in collect $5 in $5. It's not a good idea, because if you take like that, you notice your short put is 120. Is deep in the money. Anyway, based on option premium analysis, okay, 217 plus 227 plus 1 minus 1, you get 215 over here. 215 put, so we sell 215 put here. So now we collect $2.45. This is by what I call option premium. Option premium strike price selling. Sorry, I'm losing my voice again. I see from here the profit now is $246. Okay, margin requirement is still over $2,000 requirement. Now the problem for this one is that you collect less money compared to the previous price. You sell one short 118 call and short 117 put. For you to make return, you must exactly stay there. Here, the safety zone for this trade now is 215 to 121. Okay, so you want to sell option premium trade on these earnings. I said sell option premium out of the money. Option premium plus the call, option premium here minus the put. This one will give you a higher probability trade. So come, let's vote. I'll be doing one trade for you all. You want to do the first trade or want to do the second trade? So far, the vote is For first trade, the 45-cent trade, 2%, and one for the 64-cent trade. So which trade you think you want to do better? I will execute it and put it to market. Any questions? This is the cheapest form of income of earnings trade I can teach you. Okay, that I can teach you and sleep at night. Which one is more conservative? Of course, Mr. Hawk. Remember the rule of return over risk. For 45 cents divided by 55 cents, what is the return? Here is 65 cents divided by 35%. What is return over risk? So, Mr. Hawk, which one is more conservative? Okay? So let's do a conservative earnings trade. Agreed. So when you trade at time, do be careful. Do not focus on how much money can I get for this trade. You ask yourself, for this trade I collect 65 cents or 63 cents, 65 cents. I lose 35 cents. Then compared to a trade I make 45, I lose 55. Once you can work out the return over your maximum loss, you automatically know which one the highest risk. So we will do this trade. We will send this conservative trade to the market for tonight. Any questions now? As you notice, Thomas, why is lopsided? The call side here, the call side short call is nearer. The short put is further away. It is because option premium price it that way. I mean, it's not priced for the market. Remember when I say price it that way, it means that it's probably a probability for it to go down. So yes, if you base on dollar value, the chance for it to go down is much higher than the possibility for it to go up, or vice versa. Anyway, this is another subject for another day. Any questions about our good friend Appl before we go over to Google? No question, huh? Now, Google is on the 27th Thursday evening after the market close. So, Thomas, I want to sell option premium. I want to hold stock risk. Can. But you were not happy with it. I showed you why. See, the moment now you can see such high premium here. You see now, the moment see premium, $19 here, $19 there, add up together $38. $38.80 here. Do you think you can do it now? Of course, the answer is not a good idea, because the stock risk for this trade will be $8,000 over dollars. 80,000 over dollars. So for discussion purpose, while I can do an explanation, let's be honest, I don't think it will be a good idea to sell. I know some of you may be interested. I suggest you talk to me in private. Today's subject is to do what we call thinking traders trade to manage the risk to within $500 or less. And the money call is about $19-20. Okay lah, make it $20 . So underlying now is 810. So what you do, you will sell a short leg shock short earnings premium trade at 830, $20 out of the money. From here is also $20. So $20 minus this. So you end up, in this case, the put side will be $20 down the money, and we will sell 790 here. 790 call here. So now, okay, the good things about the today's market, this 79, wait. For those people who really cannot who want to really do a cheaper trade, congratulations, we can do even a cheaper trade for this trade. As you can see now, you can see here now, 10, 810, 812.50, 815, 817.50 now we got 250 strikes here. Good news or bad news? Of course, good news for us. It's good news for us means what? We can trade. People with a smaller account can trade this trade. Now, I already structure a trade that is using out of the money with out of the money option premium analysis. Now I calculate 190 here. Okay, make it okay, make it okay. Okay, make it 180 no difference. The return for this trade now is 150%. How do I know? I know. Well, sorry, more than that. Okay, it's 200% return. See now, the spread difference now is 250. So Chatai, you can do 2 contracts instead of 1 contract. Okay. See now, so the difference is credit is 180, maximum loss is 70 cents. Add up together is $250. Why $250? Because we are doing 250 spreads. Short $830, buy $832.50. Short 790 put, hedge by 787.50. So we have a 250 put. So people who got smaller accounts or smaller risk budget, happy to this trade. Now, $500 may be too expensive for some people. So like this one trade at 250 level, people like small people account with $5,000 account size, you can take this trade in and do it quite. I'm happy for you to do this trade. Thomas, you said you can S&P $500 no problem. Then why Google $500 got problem? You remember, ladies and gentlemen, Google is, which one safer? S&P 500 safer or Google safer? Of course, S&P 500 safer. The return over risk is also lower. Okay, if Google come out exceptionally bad news, you will be in deep trouble. This one is based on option premium analysis. Very simple. I teach you again. At the money call, okay, plus the underlying, give you the strike price. At the money put, minus the underlying, will give you the strike price. Questions? Thomas, can I use D15 or not? Can, not a big deal. Okay? Because the characteristics are, the payment characteristics for each underlying is quite different from each one. See, D15 here is what? Okay, here. Okay? 2650. Frankly speaking, I will not do this trade because the premium given to me will not be able to cover the risk. Let's go and find the call side. The call side here is D15 here. D15 is 760. Is 760, then the hedging rate be 7575. Okay, this is based on D15 numbers. I will not do this trade. Why? the return over premium do not justify my risk. We are aiming for at least, try to aim for 100% or more. See now we have a high probability trades, but unfortunately we are trading Google and shares. Shares is more sensitive to bad news. Return over risk 60 divided by $190. Okay, yes, 60 divided by $190 is what we call a higher probability trades. Here we cannot use option premium. It's not that reliable because we are going through an earnings announcement. Earnings announcements, as I mentioned many times, will often supersede TA, can often even supersede option premium analysis, especially when the news is unexpected. So which one I do now? Any questions? I will download the recording for tonight and send to everybody. Please ask. If you do not ask questions, it is going to be very difficult to teach you all, coach you all. Okay? Any questions? No need. Too late already. Earnings trade do not include closing order. Okay, income trade we sell 30 days, 60 days, 90 days. Yes, you can close it 2 weeks. Remember, all our trades now is expiring in 3 days period. So Mr. Kor, don't need to create closing order. That's why I said that we are still using Iron Condor, but Iron Condor for income trade on XPX is totally different. Income trade, same methodology, is no longer considered income trade on earnings company like Google or Apple. Any any questions, anybody? So now, Thomas, I do. Good question. Chatai asked me, do we check past earnings? The answer is no. Do remember, we are basing on what we call expected market. Means what? We are basing on what option premium analysis is telling us. Yes, you can check past earnings. Oh, the all-time record. Yeah, yes, you can. But that one is not reliable. Let's be honest. If really an expected event next week happen, that shoot up by $20, which you have not done for the last 5 years, last 3 years, then it's going to be very difficult to do things. Okay? Question, some more? So before we go, which one better? The 180 or 70 cents better? Aya, 70 cents is too cheap. I will not do this trade. Okay, anymore? List. You want me to teach you another different strategy? Same strategies. Okay? 180 is better. Jeffrey, for you 180 is better because you have the you have the firepower to do it. Nothing wrong. But ladies and gentlemen, I share to you different strategy. That one is based on option premium. Two is based on the probability delta numbers. Okay? Can we do a third version now? Can we do a third version now? Instead of selling $20 out of the money, why don't we sell 30? Okay? $30 out of money, so it will be 1780. Come? You see now? Sell 840 H by buying 84250. Sell 780 H by selling 77750. So if 180 can, 70 cents can, why not we cannot go somewhere in between? This one gives return. Yes, almost 100% return. About 80-90% return. 130 versus one profit is $120. Maximum loss $130. It's okay lah. This is why thinking trader. Not trick the delta. I'm not using delta. I'm using 1.5 times option premium analysis. See now, $20 here, $20 there, correct? I use 1.5 times. So 1.5 times of $20 option premium is $30. So I sell $30 of the money lah. Okay? Of course, not every time the call and puts option premium is same lah or similar lah. Sometimes the call side can be $25 and the put side $15 only. Remember, treating delta is not the right word to use, okay? My advice, use option premium analysis. Means that take at the money call, how much premium? Aggressive, use it once. Conservative, times 1.5. Extra conservative, times 2. Or use D15 numbers. So in fact, the methodology is still same, iron condor. But the fact I tweak it in such a way, the strategy to so-called execute it in this strategy is different. Will give us different risk and reward. Of course, 180 versus 130 versus 80 cents. Which one a high chance of making higher returns? Of course, a 180. Which high chance of making money is 80 cents. Which one a chance of losing the most money? Of course, 80 cents. Okay, questions? Now go to 135 already. Any questions? I think the internet got problem. StarHub don't know got down. I don't know how many of StarHub are related. Okay, they say hackers go and hack the StarHub. Attack StarHub. We do not know, we don't care. We just use it. By the way, at home I use Intel. Any questions? So which one I choose now? 140, 80 cents, or 180? I know lah. Even at low key will detect the thing lah. Anyway, before I start this webinar, I did a speed check lah. From here to go to Chandabari, I still can get 10 meg 10 meg speed which is quite okay 140, fine. You see now, so there's nothing wrong. You see now, hey, for 40 cents less, you got $10 another $20 safety zone. It will not be very much but it's still $20 extra safety zone. Okay, so we all by consensus is 140. So any question to ask before I execute a trade? Right click it. I repeat again. Tuck here. Check the price 140. Maximum loss. Now different already Maximum loss now is 110 here. If I collect 140 upfront, my maximum loss is 110. So my return over risk now is about 120% return. You notice just now I mentioned upfront to you, I want to have 100% or more returns. So this is definitely a better trade. Any questions? Of course, we put in 140 in, but of course, if by tonight later on, by afterwards, half hour from now, if market don't give us, we may want to adjust the price down to a more reasonable level. So I send the two trade-ins. At this moment in time, I do not think our good friend here is filled for us. Here, Apple. You see now, there's no field order here. Okay? So let's go find Apple. What's Apple now? Apple now asking for 45 cents. Market 45 cents is not filled. Okay, unlike a normal income trade, this style of trade now, you cannot delay too long. Do you understand why now? Because you are now nearly doing day trading. You must fill the order by tonight if you want to trade Apple earnings trade. You have no time to wait. If you do an income trade for S&P 500, 50, 60 days away, no problem. Take another 5 days away, you still got 45 days. But this one cannot. All your options expiring on 28th of October. Means that this Friday means Friday night. So I go adjust the price downwards. Right click, cancel order. We change the price, we aiming for cheaper price. See whether you can fill at 40 cents or not. Of course, Thomas Vision better trade. Of course, the Google is better trade compared to this. Because Apple now I getting 40 cents. My commission is 5 cents. Okay, so this is not a good trade for you to trade to make money. I like it because it's a cheap trade for you to learn to trade. To make money is not good. First, the premium collected is not enough. Secondly, the commission is expensive compared to the rest. Anyway, let's press a button, put in for 40 cents. If by tonight the market refuses to fill me at 40 cents, I will leave it. Congratulations. I can hear the ringing sound there. The market has fulfilled our trade for 40 cents. Gentlemen, okay, the lady have left. This is a good learning trade. Especially people like Liu and Chatai and Jeffrey and things who have not do earnings trade before, or UE who got smaller account and not so adventurous. This trade is interesting. It's good learning point is 60 cents to learn something. The safety zone for this trade now is 212. Sorry. No, the profit zone now is 212 and 212 and 112. So let's go to Mr. Chart Patterns here. So what is the safety zone? My safety zone for me to lose money. Okay, it must wait. Look. This is our short leg here, correct? 212 around here somewhere Then on top is what 121, correct? So ask yourself, based on TA, based on chart probabilities, okay, based on chart patterns and support resistance line, whatever, do you think selling a 212 call and selling a 119 call, is it a high probability trade or low probability trade? Based on chart pattern alone. Any questions? Can you hear me now? Okay, good. No questions? How about the rest? Okay. Sorry, Chatai. It seems that other people, okay, that can't be helped. We do what we can. I'll send you a recording. So next, we got this trade here, correct? Our trade for our Google, okay, our Google now is 840 and 780 call. 780 put, 840 call. Let's go and find Google chart here. Just now, what's the number? 780. 780 is right over here. So this is our safety zone for the call side, for the put side. Then the call side will be 840. 840 is above, way above a chart. I cannot draw any. Let's go back. Let's go back to 2 years. See and draw any now. 840 is multi-year high. Okay. So I think that's about it. Any questions? Any questions? If not, let's end the tonight's talk. I know some of you through internet problem cannot hear properly. I will send the link to you to the coaching group and to chat Thai also, so you all can see something. Can see something about it. If not, goodbye and good night. Safe trades. Oh yeah. Before you go, in light of the fact that I will be doing these webinar sessions so many times, the attendance is not as good as I want it to be. So I will not send the video out to everybody. Those who are interested, send me a message directly to my 9 or WhatsApp address so that I could send you the video link to you. Okay? if you're interested. If not interested, it's fine by me. Good night and safe trades.